So in this section, you will learn, number 1, what is risk management and why it matters. Number 2, what is position sizing, and finally, how to calculate your position size such that you never blow up another trading account. So this topic that I'm about to share with you is very important, right? So pay close attention. So first and foremost, what is risk management? So if you ask me, risk management is the ability as a trader to encounter a series of losses, right, and not blow up your trading account. So for example, even if you sustain a series of 10 losses in a row, your trading account should be pretty much still intact. Yes, you have a bit of losses along the way, but that account, right, should still have most of the money intact. So that's what risk management is all about. So it's important because you can have a winning trading strategy, but without proper risk management, right, you will still end up a losing trader. I can guarantee it. So let me share with you an example so you know what I mean. So let's say, for example, there are two traders, John and Sally, and they both have a $1,000 trading account to start with. Their trading strategy has a 50% winning rate, so this means they win half the time, and a 1-to-2 risk-reward ratio. So let me explain what risk-reward ratio is. So let's say, for example, you risk $100 on a trade. Okay, that's the amount of money that you're willing to lose on a particular trade. And the outcome for you is favorable. Instead of losing $100, right, the market went in your favor and you made a profit of $200. So in other words, this $200, right, is 2 times the amount that you had intended to risk initially. So this is what we call a 1-to-2 risk-reward ratio. Your reward, right, is 2 times your initial risk. So another example, let's say you have a $500 risk on the trade, and instead of losing the $500, market went in your favor and you made $5,000 instead. What is the risk to reward ratio on this trade? This is a risk to reward ratio of a 1 to 10. You were risking at $500 and you made $5,000 at the end of it. So this is a risk reward ratio of 1 to 10. Next, John risks $250 per trade and Sally risks $20 per trade. And let's say the outcome of the trades for both of them is in this sequence, right? L stands for losing, right? Lose, 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 then win, 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 win. So now what is the outcome for both traders? Let's look at John. You can see for John, he loses $250 because the first trade is a loser, loses another $250, another $250, another $250, and then he blow up. So before he could even smell the winner, he lost his entire trading account. On the other hand, let's have a look at Sally. As you can see, Sally goes through the same losing streak, right? She loses $20, lose 20, lose 20, lose 20, and then she made 40, 40, 40, and 40 because these were the string of winners at the end. But why $40 again? Because we have a 1-to-2 risk-reward ratio, right, for their trading strategy. So if Sally risks $20 on each trade, and if the market, or rather if she achieves a 1-to-2 risk-reward ratio, this means her profit is 2 times her initial risk. So 2 times of 20 is $40. So this is how we get $40. And at the end of it, Sally made a total return of $80. So that's about 8% gain on her account. Whereas you look at John, he actually lost 100% of his account. So hopefully, right, using this simple example, you can see the importance of risk management, right? In this case, both traders, they are trading with a winning strategy, but because of risk management, one of them loses his entire account and the other one is actually, making some money, right, from trading the markets. So this is important. So now the question you might be thinking, okay, Rainer, I get it, right? Risk management is important, but how do I manage my risk? How do I make sure that every time I put on a trade, right, I don't lose everything and more? So this is where the next topic comes into play. Position sizing. So what is position sizing? So position sizing is simply, right, trading the right number of units, right, such that even if a trade ends up being a loser, it's only a fraction of your trading account. Okay, let me repeat once again, right? Position sizing is knowing, right, how many units you should trade, such that if that trade goes against you, you only lose a fraction of your trading account. And as a general guideline, I usually advocate, right, not to lose more than 1% of your trading account on each trade. So for example, let's say if your account is like a $10,000 trading account, 1% of 10,000 is $100. So this means every trade you put on, you should not lose more than $100 on each trade. And now brings us to the question, right, how do we, calculate it in such a manner where, you will lose more than $100 on each trade? So to do that, you need to know a few things, okay? So this is kind of like the secret formula, right? So position size is equals to the amount to risk, right? The amount of dollar that you're willing to risk divided by your stop loss multiplied by value per pip. So amount to risk is usually, I recommend 1% risk on each trade. Some traders will go with 2 or 3%. That's pretty much, up to an individual trader. And after which you divide it by your stop loss multiplied by your value per pip. So I'm going to share with you a very simple way to do this. Okay, you don't have to. So I'll just go with you a manual way, and then after which I show you how to do it with a faster way. So let's say you're risking $100. You're willing to risk $100. And let's say, your stop loss is, let's say, 100 pips. Okay, so you put it 100. And your value per pip, right? Let's say you're trading Euro USD is $10 per pip for a standard lot. So you put here 10. Okay, you plug in the numbers, you get 100 divided by 1,000. And if you do it, you end up with 0.1 standard lot, which is equivalent to 1 mini lot. So the trouble with this is that your value per pip is constantly changing. It really depends on the code currency. It depends on the account funding that you have funded with your account. So you can see that things can get really cumbersome, right? So one thing I suggest is to use a position sizing calculator to make your life really easy. And I'm going to show you how to do this step by step. So you can Google, position sizing calculator, and this is one that I've found. You can, use it. It's free. So let's say you are trading again Euro USD. Your account currency, let's say, is in US dollar. Let's say your account size is like what I shared earlier, $10,000. And your risk on each trade, let's say, is 1%. You can put here 1%. In this case, you can ever switch to, dollar terms. Let's say you want to risk $100, which is also 1%. That is fine as well. But in this case, let's go with the percentage. Let's say 1%. Let's say your stop loss in pips, right, is 100 pips. Put in 100. Contract size, let's leave it at 100,000, which is equal to 1 standard lot. Click calculate. And there you have it, right? It tells you the lots to trade is 0.1, which is equals to 0.1 standard lot or 1 mini lot. Can you see how fast this is? Let's do another example. Let's say this time around you're not trading Euro USD. You're trading pound against the Aussie. Let's say your account currency is in New Zealand dollars. Okay, and let's say this time you're a baller. Your account size is $100,000. And you're a baller and you still risk 1% on each trade. Well done. And let's say your stop loss this time around is 350 pips. Contract size again 100,000. You click calculate, it will tell you how many units to trade, right? Such that even if the trade hits your stop loss, you will only lose 1% of your account. So you click calculate, and in this case, it tells you that you can trade 0.263 standard lot, which is about 2.63 mini lots. Make sense? So again, this is very useful. So again, let's interpret this together. So this means, right, for this particular pound or Aussie trade, and let's say your account is in New Zealand dollars, and you're risking 1% of this $100,000, this means, right, if the trade goes against you, right, with a stop loss of 350 pips, right, you will lose, right, $1,000, 1,000 New Zealand dollars, right, in your trading account, which is the 1% that we have defined over here, right? And this is the position size that you should be trading with, 2.6 mini lots. Okay, make sense? So this is how you use a position sizing calculator. So again, let's do one more example so you really understand this big time. So let's say this time around we do something simple like Aussie dollar. You want to trade the Aussie against the US dollar. Let's say your account currency is in Aussie dollar. How about that? Same. Just put Aussie dollar. Let's say your account size this time around is $5,000. And let's say you are risking a little bit more, 2% risk on each trade, which is still about $100. So your stop loss this time around, let's say it's only 50 pips. Okay, contract size again 100,000 units. So now the question is, how many units, right, should you be trading such that if this trade goes against you and hit your 50 pip loss, the loss on this trade is only 2% of your account, 2% of this $5,000, 5,000 Aussie dollars. Click calculate, and it tells you that you should only be trading 1.53 mini lots. Make sense? Okay, so don't worry, I'll share with you. We'll talk more about position sizing, risk management with chart examples later on. But for now, I just want you to know how to use this very useful calculator. Just click Google. There are many free available ones, and just pick whichever that you're comfortable with. So let's do a quick recap. Number one, position sizing is the tool to manage your risk, and use a position sizing calculator, right, to make your life easier. I don't expect you to manually calculate it. Most brokers usually have an inbuilt calculator function. If it doesn't have, right, then just you go to any of the free website via Google, and you can use the calculator to help you calculate the number of units to trade, such that even if the trade is a losing trade, right, you only lose a fraction of